Hi, everyone. Welcome back to Words on Wealth. And today I'm talking about quarterly earnings reports. Specifically, that Donald Trump has announced this week that he wants to try and change the frequency of quarterly earnings reports to actually every 6 months, so biannually. But if you think this is kind of niche, kind of detailed, and maybe doesn't affect you, particularly if you don't invest into direct stocks, then think again. This could affect all of us, no matter where we invest or how we invest. So, in this video, I'm going to break down what these earnings reports actually mean, why Trump's decided that he might want to try and reduce the frequency of them, and what it would actually mean for you and your money, no matter where you are in the world, or as I say, how or where you invest. So, earnings reports are something that by law has to be produced by every publicly listed company. That is, companies that are available on the stock market to be bought by you and I publicly. It's kind of part of the deal. As and when you list on a stock market, you sign up to this level of public scrutiny. Now, when they give us an earnings report, they make a quite big announcement usually, and it contains all sorts of information about financials. They'll usually give us information that are things like profits, losses, also the balance sheet, where cash has gone, all of that information that we could possibly need about spending in that quarter. They might also give us some information on forecasts, for example, for the next quarter, so that we can see where the company might go. Now, generally, stock markets really wait with bated breath on these earnings reports. They are usually one of the hinge points of the year for each and every stock that does report, because what they do is they give investors an indication as to how well the company's doing, how well the company thinks it's going to do, and this helps them to make a decision as to whether they want to buy or sell. There's also a lot of predictions done by analysts in the run-up to the earnings reports. I know it's kind of like doubling down, but a lot of these do cause a lot of noise and movement within the stock prices before and after their earnings reports as well. And it's been mandatory since about the 1970s that companies produce these reports quarterly. The reason being is that that is seen as a frequency that allows investors to make informed decisions. It allows things to move and change within the company, but not too much, because it does keep those informed that need to know about what is going on. Now, Trump has said in the last week that he wants to change this frequency from quarterly to every 6 months. It's a bit of a novel idea. The reason why he's claimed he wants to do it is sort of twofold. Firstly, he's saying that it helps reduce compliance costs for the companies that have to produce these reports. And secondly, he says it helps management take longer term decisions rather than having to focus on really short term goals, both from a financial perspective, but also in a company wide budgeting perspective. Zooming out, it might also make listing on the stock market slightly more attractive for companies that are currently a little bit hesitant. Of course, if they're currently privately listed, then these obligations are there as much. They don't have to produce these reports if they're not listed on the stock market. At the moment, we've seen a bit of a slowing in companies choosing to list on the stock market or go through what's known as an IPO, an initial public offering. There's all sorts of reasons for this. It could be argued that one of them is the costs and the associated paperwork and compliance that comes with listing on the stock market, one of which, of course, is these quarterly obligations. Now, it's not set in stone. He's just said for the moment that it's something that he wants to do. So how likely that is, then your guess is as good as mine. It could take some time for this kind of ruling to actually kick in. Of course, it can't just simply change overnight. Often companies will have all sorts of procedures and regimes in place that have them set up on this system so that they're ready to go as and when is needed. So it could take until 2026, even later, if it were to be actually put through and put into place. Indeed, the regulatory environment in the US at the moment is leaning towards more deregulation. Trump is certainly favouring a more relaxed attitude from the SEC, who are the financial regulators in the US, amongst others as well. So it could well be that it's something that could be seen as favourable amongst those supporters. Some companies might still, of course, choose to still produce these quarterly reports, even though it's not mandatory. This might be to do with still keeping investors happy, still being an attractive company, but also keeping it globally, because it's not just the US, where these quarterly reports are mandatory. In fact, it's pretty normal across the globe that publicly listed companies have to do this. So if the US is the only one producing every 6 months rather than every 3 months, it could put them out of whack with others. There have been mixed responses to the suggestion. Some groups are saying that it could be good news. It could help drive business growth in a particularly tough time for the US economy and, to an extent, markets as well. Others are saying that actually it reduces protections for investors. It makes things less transparent when it comes to their investments, and it could potentially cause bigger swings, so higher levels of volatility in the price of individual stocks, which can feed into the wider markets and also then, therefore, our portfolios. The reason why that is because if there's a longer period from which we don't know what's going on behind the scenes, and then suddenly an earnings report comes in after 6 months that's way more negative than anybody had thought, this could cause the stock price to drop even lower than perhaps if there'd been some forewarning 3 months earlier, for example. And as I say, this could ripple on through, not just from the individual stock, but also to the wider markets, to those that are associated with that company, for example, in the industry, and then also into our portfolios. Another downside could be that with less publicly available and mandatory information that is pretty set across all the companies that are publicly listed on the stock exchange, means that investors have to rely more upon other sources of information, which can become murky in their reliability, arguably driving more volatility along the way. This is things like news reports, analysts' predictions, and anything else that's going on. We've seen over this summer, for example, a few news reports around the ousting of various CEOs, won't name any names. What that does is it causes ripple effects into their share price. And that kind of news could have an even bigger impact because investors and the market have nothing else to go off. And so what this could do is actually inadvertently cause more volatility and more pain, therefore, for investors if they're seeing big peaks and troughs in share prices. And then, as I mentioned before, that ripple down effect into their portfolios. So if the rules do change, this could be a big shift of how the US market behaves and responds. The vast majority of us will have some level of US market investments in our portfolios, be it even through our pensions, whether we realize it or not. So this announcement doesn't just affect those that are stock trading, for example, looking at the prices of individual stocks, but it could well affect all of us, particularly if it causes more volatility in the US market, or indeed other regulatory changes across the globe if other countries and other regulators decide, for example, to follow suit or equally double down in the opposite direction. The debate also highlights something beyond just the financial too, because it's never just financial, but it's also about access to information. It's about the changing ways in which we access information and how accurate that is. And of course, it's also about that political spectrum in the US and how this is altering access to information and what the world looks like when that pans out. How we value long-term and short-term success really ties into this notion too. So if we're thinking about being a long-term investor, no matter how hard we try, we'll still be affected in some way, shape, or form by the short term. It's about trying not to react too wildly and understanding what's going on behind the scenes so that our emotions don't take over if we see some big swings within our investments. Hopefully that gave you a good overview on this week's announcement around earnings reports. And if you weren't aware of the announcements, you've just got an extra little nugget of information around how the stock market functions and how it could potentially impact you and your investments. I hope you're enjoying these videos. Do make sure that you like and subscribe, and feel free to drop me any comments as well. Have a lovely day.